Hello, and thanks for tuning in. This is a detailed explanation on what a reverse mortgage is, with pros and cons. And before I get started with this video, I'd like to say that YouTube is an incredible tool to explore topics of all kinds, but it's amazing to me that people can make videos with the best of intentions, but if it's not what they do for a living, they can only give limited information, and sometimes it can be inaccurate, outdated, and critical details get missed. This can be said of the reverse mortgage. I've watched a lot of reverse mortgage videos on YouTube by people who are investment people, financial pundits, and proclaimed personal finance experts that are not altogether accurate, and I'm here to set the record straight here in 2022. So in full disclosure, I am licensed in California to do reverse mortgages. So what is a reverse mortgage? A reverse mortgage is a loan against your property where you receive funds in a lump sum or in a form of a line of credit for you to tap as you see fit. On the line of credit option, you can receive equal payments for a period of time or let the funds sit in a line of credit for you to use at a later time and take advances from it. And you can switch back and forth. It's flexible. You can go to the lump sum, back to the monthly draw. It's very flexible. I hear people in various videos say that reverse mortgage is additional income, and that's incorrect. It's not income. It's leverage money. You didn't earn it, so any funds taken in the form of a reverse mortgage are accumulating interest that needs to be paid back at a later point in time. Now, on a reverse mortgage, you don't have to make monthly principal and interest mortgage payments on the loan. People say, well, what's the catch? The trade-off is any interest and expenses that accumulate on the used funds gets paid back once the home sells, or the loan gets refinanced, or when you no longer occupy the home as your principal residence. One thing I don't hear in videos is that you may not rent out your home if it has a reverse mortgage on it, but you can rent out rooms if you stay there at least 6 months and 1 day, one per calendar year. If you are out of the home for health reasons for 12 consecutive months, then this is a loan maturity event and the loan would have to be paid off. The minimum age for a reverse mortgage, it depends on what type of loan you're getting. One of the loans is 55 years of age, another is 60, another is 62. So they all have their own different rules on them. It's really important you know exactly which loan a loan consultant is talking to you about. I can't stress that enough. So you are still responsible for annual property taxes. I do see some videos out there on this, and for good reason. Homeowners insurance and monthly homeowner association dues, you still have to pay those on your own if, on the reverse, if the taxes and insurance aren't rolled into the loan. So like with any mortgage, those have got to get paid. Here's one thing you may not know. If the county forecloses on a property to collect delinquent property taxes, they can sell the home and not be required to give the lender a dime. This is why lenders freak out when there are taxes that are due, property taxes that are due, because they don't know what the county's going to do. So you don't want to be in that situation if at all possible, which is why these lenders can be aggressive in moving in to protect their interest. So why can't a lender pay the delinquent property taxes and just add it to the balance of your loan? Unfortunately, with the FHA HECM reverse mortgage. Now, HECM is HECM, stands for Home Equity Conversion Mortgage. It's the most common reverse mortgage that's done nationwide. They don't allow taxes to be paid in advance and tacked on to the balance of the loan. That's just something FHA does not allow. There are other non-FHA reverse mortgages where they may be able to do something like that, but it's on a case-by-case basis. So reverse mortgage lenders now run a financial assessment to make sure the prospective reverse mortgage borrower can pay their property taxes and charges in a timely manner. If they can't, they either don't qualify for the reverse mortgage loan or a life expectancy algorithm is done, and that number of years of property taxes gets rolled into the loan, and the lender pays those when the tax installments or the homeowner insurance becomes due. It's no longer that if you have an abundance of home equity and you have a pulse, you get a reverse mortgage. That's the way it used to be. But new loans going forward from 2015 have this financial assessment in place. Fortunately, the older loans don't. So there still may be some recurring problems on those older loans with delinquent property taxes. Regardless, no matter what kind of real estate loan is on a home, the property taxes need to be paid, or else there's a chance of the county or lender foreclosing. Now what I do, I check once a year on all my reverse mortgage loans that I've done to make sure their property taxes have been paid. Because sometimes people forget, or they went through a stressful life event and it's not top of mind, or they've lost some cognitivity. If they haven't paid, I'll call them to see if everything's okay. If not, we try to make payment arrangements with the county, and if there are no reverse mortgage funds left in the loan to pay them, that's the first thing we try. I work with them. The last thing a lender wants to do is to foreclose on a property, especially on a reverse mortgage. It's totally against the true spirit of the reverse mortgage, which is to allow people to age in place on their own terms. But unfortunately, these property tax foreclosure defaults do happen from time to time. So on a reverse mortgage, you own your home, just like a conventional loan. You do not have to sign title of your home over to the bank. And if you sell your home after the accumulated interest and other charges are paid off, you and your heirs get the equity, not the bank. Didn't you always used to be that way, though? In the 60s and 70s, that wasn't the case. And this is what people remember. People looking at reverse mortgage loans remember those days and what a bad loan it was. But after 1989, when the reverse mortgage was put under HUD FHA oversight by President Reagan, that stopped. But people remember those days. You can't blame them for the mistrust in the reverse mortgage. You really can't. But it's important to note there have been program updates and guideline changes that have made the reverse more user-friendly that you may or may not know about. There's also a few types of reverse mortgages that are not the same, and they have different rules. The FHA HECM, again HECM, Home Equity Conversion Mortgage, is the one we see on TV all the time. There are also non-HECM reverse mortgages available that have lower closing costs, but the trade-off is the interest rate is higher. So which is better? I have a video on my YouTube channel, Kevin Walton Reverse Mortgages, where you can go check out the different types. I do spreadsheets and a cost analysis on those loans so you can see the difference in how they work. The non-HECM reverse mortgages can do things that a HECM cannot. It can give higher loan amounts, up to $4 to $6 million. It can be done on a condominium complex that is not FHA approved. FHA, Federal Housing Administration, there is a certificate that each condominium association can get if they fill out the paperwork and get approved by FHA standards. And that way FHA loans can be done in that complex. But the last several years, a lot of FHA associations aren't doing that paperwork anymore. So FHA loans, which means a HECM reverse, cannot be done in there. The non-HECM loan will go ahead and do a loan in a complex like that, if that is not FHA approved. And the guidelines are more liberal on the non-HECM reverse mortgages. Again, take a look at the video. It'll tell you a little bit more of the differences between the loan type of loans out there. What are some of the pros on the reverse, and when would you use a reverse? Well, if you need additional cash flow during retirement, for example, paying off your existing first mortgage and not have a monthly mortgage payment, this can create immediate cash flow. The reverse mortgage must be in first position. It has to be a first mortgage. So if there's an existing first mortgage there, it needs to be wiped out and paid off with a reverse mortgage. Plus, if you have additional equity left after paying off the first mortgage, a line of credit can be established, and you could draw from that as you see fit. That HECM line of credit option is better than a bank HELOC. And here's why. On a bank HELOC, you have to income qualify to get that, which can be difficult for some people in retirement because their income might take a dip. Also, with the HELOC, it can be closed out, frozen at any time without announcement if property values drop. You have no control over that. Also, the HELOC is only good for 10 years. After 10 years, it freezes. So it's a short-term type of a loan. The HECM stays open the rest of your life. It cannot be closed if property values drop. So it's a little more of a dependable source of funds if you need them. When you want to buy a home and can't income qualify for a loan, you can use a reverse mortgage to buy a house. A lot of people don't know that. It's basically if you have 50 to 60% down payment, but can't qualify for a home loan for the balance, a reverse mortgage may kick in the difference. And again, you don't have to make any monthly payments on the balance of that loan. So the loan amount will vary based on the minimum age of the youngest borrower, as well as the other factors I just mentioned. So I have another YouTube video that explains a lot more of this in detail, but just know the reverse mortgage loan amount could be different for every person because it depends on the age of the youngest borrower, equity in the property or down payment, as well as prevailing rates. Basically, with prevailing rates, the higher the rate, the lower the loan amount you get. So with rising rates that have been happening in 2022, loan amounts have been dissipating some. Another thing you can use the reverse for that's a pro is using the line of credit, HECM reverse mortgage line of credit option, as a bucket of money, not in the market, to dip into in a down stock market year. The idea is to take funds from the line of credit immediately following a down market year and not from your nest egg to give it time to recover. Just leave it in there. History has shown the dollar amount your portfolio will gain back by allowing it to recover will far outweigh the interest cost of the reverse mortgage. Also, the available line of credit to use, it grows every month into more funds to use later. A lot of people don't know about that either. You don't have to do anything for that to happen. It's tied to the interest rate of the loan. This option, again, it's on the line of credit option, can be used and is used by affluent borrowers as well. A retiree can never have enough buckets of money not in the market to pull from when their investments are tanking. Like right now, in September 2022, investments are taking a hit. At the beginning of next year, when they take their annual withdrawals, they should really do some serious thinking on whether not to take any withdrawal from their investment that year and to take it from somewhere else that's not in the market. The line of credit can serve as that bucket of money. And again, I do have a case study on my website, on my YouTube channel that shows that. It's about 8 minutes long. Also, another pro is that you get to use the line of credit for in-home healthcare. Aging in place is what people want to do. I saw some videos that said you don't want to do reverse because the interest that goes up every month on your loan takes away from the profit that you're going to need to pay when you go into assisted living. Well, I don't want to go into assisted living. I don't know of anybody who does, unless it's absolutely needed. If you can't get the level of care in your own home, the reverse can help pay for that care. Another thing you can use the reverse for that's a pro is a strategic tool in a divorce. When one spouse wants to stay in the property but is having trouble qualifying for a cash-out refi to pay off the departing spouse, the reverse mortgage come into play because the income qualifying for the loan is much more lenient than it is on a conventional loan. Plus, you can use the reverse to pay for home improvements, to right-size the property, a walk-in tub, some other modifications, vacations, vehicles, children and grandchildren, their education expenses. It's really a myriad of things you can use the loan for. Now, I mentioned it's easier to income qualify for a reverse than a conventional loan. Here's a quick example. I had someone go to their bank to get a $100,000 HELOC. They had an existing first mortgage, so they had to qualify making that payment as well as a payment for the HELOC and their other debts. She needed $8,000 a month to qualify for a $100,000 HELOC. I was able to get her a $300,000 reverse mortgage line of credit. She only needed $1,500 in income. It's not any smoke and mirrors. We do not use debt to income ratios on reverse mortgage when qualifying. We use residual income. It's much different. Again, there's another video on my website that explains that. But just know, income qualifying for the reverse is much more friendly. The reverse also requires third-party counseling. Before you get a reverse mortgage, there's a checkpoint. And what I really like about this loan, you can't rush people into it, especially in California. So before we can take an application, you have to get third-party counseling from a HUD-approved counselor to make sure you understand how the loan works. I make videos for all my customers, all my prospective borrowers, that explain everything to their unique situation, so my borrowers don't normally have a problem understanding how the loan works. Then after the counseling is done, 7 days have to pass before a loan application can be turned into a lender. That gives the borrower more time to ask questions and make sure this is something they understand and really want to do. So borrower counseling is something that is a very good thing. So with these pros, the reverse mortgage is becoming an estate planning Swiss Army knife of sorts for all kinds of purposes. So what are some of the cons and some of the drawbacks? And there are some. First, by not making monthly payments, your heirs are losing equity or part of their inheritance. If heirs are not aware a reverse mortgage is in place on their parents' home, let's say, for example, and the mortgage balance has significantly increased since no monthly mortgage payments were made for a dozen years, let's say, there can be a pretty rude awakening and surprise when it comes time to liquidate an estate and sell the home, and not in a good way, because they see that all this interest is going to the loan and not to them. So to a lot of people who don't know their folks have a reverse, it's not pleasant. They don't have a lot of good things to say about it. You just have to look to see if it really improved their parents' quality of life. But when you're looking at a monetary situation for your inheritance, yes, it could take away from that. Another thing is if you're living with your parents while taking care of them, and they have a reverse mortgage on their home, if you are not on that reverse mortgage loan, upon the passing of the last living parent, the loan must be paid off. Or if there's enough equity left in the home, then you can get your own reverse mortgage to pay off your parents' reverse mortgage. And you may not assume a reverse mortgage loan. You can't just take over your folks' loan. So the key here is to know whether or not your parents have a reverse mortgage in place or not before you move in to take care of them. Because that way you'll know you have to make alternative living arrangements once the last living parent passes away. Not knowing this information can be a harsh reality, and I've talked to people who it happened to, and it's sad. And again, they don't have a lot of good things to say about the reverse because of it. But it's just that they didn't know. They didn't know, and they had to find another place to live. Another thing is property tax defaults. If you can help your parents or the person who has a reverse mortgage on their property check twice a year, like I do for my clients, to make sure they don't forget to pay their taxes, it's a huge help. Because if they don't have the funds, they can try to make payment arrangements with the county. And also check with HAF, H-A-F. It's a U.S. Treasury program. It was made for people who experience problems due to COVID, and it'll help them pay property expenses, taxes, insurance, and whatnot. But there's still a lot of money left in there. And so they're going to keep that money available. So for people having problems paying their property taxes, half might be a place to turn. You just Google it and you'll find the information on it. You can also go to my website, and under one of the tabs, it says Senior Citizen Help, I believe, and half will be listed on there. You can just click on it and it'll take you there. So property tax default foreclosures just don't happen on reverse mortgages. They unfortunately happen on all mortgages if you fall a number of years behind. Also, it's worth noting, if a property is upside down, where the amount owed is greater than the home's value, and it comes time to sell the home, heirs in that situation usually just let the lender foreclose on the home since they aren't going to get anything out of it. Why spend the energy to sell it? This is a voluntary foreclosure. These voluntary foreclosures get lumped in with involuntary foreclosures and can give people the impression there are more involuntary foreclosures than there really are. Another side note, if the home is upside down and the family still wants to try to retain the home, they don't have to kick in the difference between what is owed on the home and the value. If it's a HECM reverse mortgage, the insurance will pay that gap. And then the lender will come out and appraise that property. And the heirs have a chance to buy the home for 95% of that appraised value. That's when the home's upside down. Another drawback on the reverse is the cost to originate the reverse mortgage. The FHA HECM reverse mortgage requires something called MIP, since it is in the family of FHA loans. MIP serves, as I just mentioned, as gap insurance. If you owe more than the home is worth when it comes time to sell, the insurance pays the gap. All FHA loans, whether it's a reverse mortgage or whether it's the first-time home buyer 3.5% down payment loan or a 203K buy and rehab home loan, all FHA loans have this MIP. It's not just HECM reverse mortgages. But it's expensive, and the upfront cost to start the policy gets rolled into the loan. And there is also a monthly premium assessed as well that gets added to the loan balance if not paid. The reverse mortgage upfront premium is higher on the reverse mortgage than the other FHA loans due to its risk of no payments having to be made. The other loans that FHA does are forward mortgages, which is when you make monthly payments. This insurance is vital to the HECM reverse mortgage survival. 4 years ago, the MIP insurance fund lost almost $3 billion in payouts where properties were underwater when it came time to sell the property. Although the last few years those numbers have greatly improved, but still MIP is necessary to allow the HECM program to survive. Currently, 2% of the property value, with a cap on values at $970,000, is required up front to start this policy and gets rolled into the loan amount. So in a home of $800,000, let's say if it gets appraised, 2% of that's $16,000. That is an insurance cost that gets rolled into the loan amount along with the other closing costs with a loan. Title insurance, escrow, all the regular loan fees you run into on a conforming loan. Plus there's a monthly premium, MIP premium, that gets added to the loan balance if not paid, as I just mentioned. It's the same amount for all HECM borrowers, regardless of your credit score, regardless where you live, and how old you are. It's a national program. So the cost for an FHA first-time home buyer up front, the MIP is 1.5% of the purchase price. And that gets rolled in a loan. So it's a little bit lower than the reverse mortgage upfront premium of 2%. So the MIP, again, is not meant to be a punitive insurance fee to reverse mortgage borrowers. It's an FHA loan requirement that all FHA loans have to pay. And that includes the FHA HECM reverse mortgage. So all the other loan costs to originate a reverse are similar to a conventional loan. There are other reverse mortgages that do not have this insurance. I have a separate video on my website that claims, that shows how those other loans work, and it's also on my YouTube channel. It goes more into detail on the differences of those loans, But I've done some of those loans where the upfront costs have been about $1,000. But please know, each reverse mortgage loan is non-recourse, meaning if you owe more than the property value when it comes time to sell, the lender either has insurance, like on the FHA HECM reverse mortgage, to pay the gap, or on the non-FHA loans, the lender eats that difference, not you or your heirs. It's very important you know that. I've seen videos that say the opposite of this, and that's not correct. Interest rates also are higher on reverse mortgages than a conventional loan. Currently, as of 2022, an FHA HECM reverse mortgage is roughly 0.5% to 1% higher in rate than a conforming loan, and the non-HECM reverse mortgages can be an additional 3% higher in rate. And that's again because they don't have that insurance, so the rate's a little higher. However, income qualifying is much more forgiving, and sometimes the interest rate honestly isn't as important as it is as creating improved cash flow. That might rub against people's grains, maybe a CPA who's numbers driven. It may not make sense. But for cash flow and comfort, quality of life, it does make sense for that person. It just depends on the situation, though. So here are a few things not to do when applying for a reverse mortgage. Don't take your spouse off title. If you're looking at a HECM reverse mortgage and a spouse is 58 years of age, they do not meet the minimum age of 62. So some salespeople say, well, just don't put your younger spouse on title to the loan. No big deal. Well, it can be a big deal. Because it used to be if the older spouse passed away and the younger spouse wasn't on title, they got kicked out. Not okay. Now, since 2015, as long as we know up front there's a younger spouse there who does not meet the minimum age requirement, they can stay in the home on a HECM reverse mortgage for the rest of their life, as long as it's their owner-occupied property. They just don't get access to the money. So if there's leftover funds on the line of credit and the older spouse dies, the line of credit gets frozen. So if there's some warning of some not so good health, might be a good idea. I have people call me. I'll say, hey, it might be a good idea to pull out the rest of the money, the credit line, so you have it in your bank account to use. Also, if you have an abundance of equity in your home and you're being told you must take out an initial advance of all the available lendable equity at loan closing, think twice. You may or may not need to do that. The loan consultant, like myself, honestly, they make more money the larger your upfront draw is. If you want to take out a line of credit and have a home that's free and clear, no mortgages, you just want to have a line of credit available to draw on when you need it, don't fall to the pressure tactics to take out more money than you need. The loan consultant can structure the loan in a way where they can get paid a flat fee instead of a percentage of how much money you take out up front. One other thing to look out for and not do when you're applying for a reverse mortgage, check out the reverse mortgage originator you're speaking to. Go to the NMLS.org consumer portal and check them out. Make sure that they are listed as an active licensee and that they are not under someone else's license and not their own. I wouldn't use someone like that. Someone says, oh, I'm just in the process of getting my license. No, they're not licensed, period. And they're just using their boss's license to originate loans. Not okay. You don't know if that person has any past infractions against them. So use that site. Very important. So a few last thoughts. In the end, reverse mortgage is simply a tool you can use in pre-retirement, post-retirement, that gives you options to convert your accumulated equity into lump sum cash or a line of credit to use for a myriad of reasons. There's an old saying, I remember my parents saying it, don't hawk the house. If you don't know that saying, Google it, look it up. And conventional wisdom used to say you absolutely need to pay off your house before you retire. But today, things are different. Retirement strategies need to be re-engineered. Reverse mortgages are not a fit for every family dynamic. And borrowing money using the reverse mortgage during retirement may not make financial sense to some people. But incorporating home equity into a retirement, not just when you are short or when you've run out of money altogether, incorporating home equity into the retirement needs to be looked at. For some people, home equity is their largest asset. Using it carefully can help ensure people don't run out of money during retirement. We're all living longer. And I don't understand how some videos out there say to avoid a reverse mortgage at all costs, especially when some people with ample equity can greatly improve their quality of life and care. Leaving equity to your heirs is a wonderful gesture, but there's nothing more important than quality of life. To me, it's more important than any number. But again, to some people, they just can't get past that and may not make sense, and I respect that. I have a dozen reverse mortgage videos on my YouTube channel that go into finer details on reverse mortgages, all different kinds of videos that are there. Types of reverse mortgages, how to qualify for a reverse mortgage, a case study on how to incorporate equity into a retirement, and half a dozen more. Feel free to go over there, and if a friend of yours or relative has a question on reverse, you can steer them over there. The loans are the video is very transparent. And if you have any other questions, you can go back to my website and click on the upper right Tell Me Your Scenario button and ask me any question. Now, I'm licensed only in California, but I'll answer any question in any state. Just give people an answer. And if you have a current quote that's out there, feel free to run it by me. Even if I don't do the deal, I could tell you where you can maybe cut some corners and maybe get a little better deal. So make sure and click the subscribe button on down below. And I hope you found this video helpful and explained a few things that weren't covered in some other reverse mortgage videos. Thanks for your time. And again, go to the website. Feel free to surf it and tell me your scenario. And thanks again for your investment of your 20 minutes to watch this. I hope you got something out of it. Thanks, and bye for now.